Hi everyone, welcome to our latest instalment for our education for our clients on investing in the share market. Over the last probably 6 to 12 months with COVID and with interest rates falling, we've been inundated with queries about investing in the share market to try, as people are struggling to get a return on their investments in term deposits and cash, they've been turning to the share market to try and get a return for dividends and for capital growth. And to help them retire and to help them make some money. So we thought it was a good time to stop and think and explain a bit about what the share market is about, and hence why we've started this series. We've got a 4-part series. We're going to take it block by block through all the different mechanics of the share market and the way it works. So bear with me today, and I want to start off by talking a bit about what is a share straight off the bat. And I always use the example, probably of Woolworths is a great example, where people own 1,000 Woolworths shares, and what technically do they own? And you are a part owner of Woolworths, but you are what we call a minority shareholder. You only own a very teeny weeny amount of the entire company. But as a part owner, like you would be a part owner of any business, and my mother was a florist and she owned 100% of the shares in her company as a florist, she was entitled to the 100% of the profits from that florist shop. But when you only own 1,000 shares in Woolworths, you only own that percentage, which might be 0.01% of the entire company, but you are a part owner and you are entitled to dividends and therefore profits over the time you're a shareholder. Now, being a shareholder in a company, you might say, well, does that mean I can just ring up Woolworths and tell them what they're to do with their money or their stores? Or do you walk into Woolworths down at Mitcham there and say, hey, I'm a part owner, you need to clean up aisle 7? No, it doesn't mean. You can't do that. You can't walk in and pretend you're the big boss of the place. And that's where shareholdings and investments in these companies is a little bit different. Yes, you are a part owner, but no, you don't have a say in how the company is run on a day-to-day level. What do you have a say in as a minority shareholder? You're still entitled to a vote, and you get to vote on who is the board of the company. Now, who then, you could walk into you get invited to the annual general meeting, the AGM, you get to vote on who is on the board. Why is that important? Because the board then decide who the CEO is, and the CEO is the one who decides on how the company is run. So in essence, if you don't like how the company is run, do you have any say on how Woolworths or any company like that is can you change anything? Can you do anything? Really, at a board level, no, not much as a minority shareholder. So therefore, people say, well, if I don't like how the company is run, what choice do I have? Well, the simple choice is you can sell your shares. Don't own them. That's the simple way out of it. But as a minority shareholder, you need to know where you stand. Now, what we'll walk through today is also what you're entitled to dividends as a shareholder. You're entitled to sell your shares and all sorts of things, that benefits that come as a shareholder. But one of the things that I want to distinguish between is borrowed money or money that's lent into the company versus equity. And this is a clear distinction. So when Woolworths goes and say they want to build a new store, they have the choice of raising new equity capital from shareholders and issuing them new shares, or they have the ability to go borrow money and borrow $10 million from a bank and lend the money in that way. Now, what is the key difference between those two? With the shareholders, if you issue new shares and you allocate shares to somebody in ownership, do you have to pay those people back? Do you have to repay their money? No, you don't. That's not how this works. Do you have to pay them ongoing dividends? No, you don't. That just depends. And dividends only get decided on whether the business is making money or not. Whereas on the other hand, borrowed money, you have to A, pay the money back. There's a set time frame and a repayment schedule, and B, there'll be an interest rate. You have to pay the interest rate, because if you default on that loan, then the lender will come in and take over and ask for his money back. So having equity ownership versus debt ownership are two very, very different things, and you need to be very careful of what they are. One of the next things that I want to talk about is basically talk about how people make money out of the share market. And one of the things that I talk a lot about with the share market is talk to clients about just remembering that the share market is like the man walking up the hill, but the man has a yo-yo. So one of the things that will absolutely drive you insane where you watch share markets over time is if you watch the yo-yo going up and down, like we've just been through in the last 12 months with the COVID situation, it'll drive you batty. But if you watch the man walking up the hill, that slow incline over time, you will be well rewarded for that. So a lot of times you'll hear a phrase in the share market sense of time in the market, not timing of the market. It's designed to say just, I guess, bank on patience, bank on good businesses getting better over time. And I think that COVID has proved that this is particularly true, where if you watch the man with a yo-yo, you saw the yo-yo fall when you panicked, or you felt very, you made a decision to get out at that time, you could have potentially lost between 20 to 30 to 40% of your money by cashing out at a bad time. So watch the man walking up the hill, don't watch the yo-yo. One of the things that I want to also talk about is that there are different types of shares on the share market. Now, and they all have different income and growth characteristics. So one of the things that I can probably use to describe this is a business, and I'm going to use the CSL as a great example. Many of you will know CSL. CSL has been around for a long time, and it is typically what we refer to as a growth company. What makes it a growth company? A growth company means that they're probably, what they are is they're making money, yes, and they might make $200, $300 million, but they don't give that $200 or $300 million profit back to its shareholders. What they do is they take that $200 or $300 million and they say, you know what, we've got to do more research, we've got to develop new products, we have to develop new distribution systems and things like that. And they take the profit and they reinvest it back in the business. And over time, and they might pay you a small dividend. I think CSL pays about a 1% dividend, which is nice. It might pay for a small meal at the pub or something, but it doesn't go very far. So therefore, by reinvesting, they are making an assumption, and that board is taking your profit that you've, as part owner, has made, and it's taking it saying, do you know what? We're not giving it back to the shareholders because we believe we can grow that money faster than you can grow that money. And they then take that, and then by reinvesting it, what you are hoping as a shareholder is that you are hoping they take that money, reinvest it, and then profits continue to grow year after year after year. And if the profits continue to grow because of their focus on growth, what should technically happen to the value of the company? If you've got a growing profit share, it becomes more value. Therefore, you will see the share price escalate and escalate and escalate. And CSL has been a great example of that. So you haven't got the dividends along the way, but you have seen the share price go up. Now, for someone who is retired and is wanting to live off the money, they can't take their return out unless they sell the shares. So, because you're not getting enough dividend out of a company like that. On the flip side of that, I guess as an extreme, might be one of the banking companies. I'll use Commonwealth Bank as an example. Commonwealth Bank make a profit every year, and they pay out probably around 80% of their net profit every year to its shareholders. That's because it's the type of business that says, hey, we don't need this money to grow. We actually have quite a good business. We don't need all of the profit to go and do any expansion activities. And therefore, they pay the majority of its profit back to shareholders, which is why a dividend yield of a bank might be 5 or 6% as opposed to CSL's 1%. But on the flip side of that, if they don't reinvest back in the business, and therefore you might find that those types of businesses don't grow their profits as fast, and therefore you don't see the share price escalation as high. So you'll sacrifice some of the growth in the share price to get your income straight away. And those trade-offs exist everywhere in the share market, and you need to be very, very careful of those. At the very, probably even at the very extreme level, you will have a growth company that pays no dividend, and it might be some tech companies that are just in growth startup mode, and they will just make their money and keep reinvesting and not pay any dividend to you at all. And that isn't a bad thing. Not paying any dividends doesn't mean the business is going bad. It just means that you're going to have to see a return from the share price. Other terms that you'll come across is stocks that we call them defensive stocks. Defensive stocks are stocks that are companies that, like I'll use Woolworths as a great example, or Bunnings, which is Wesfarmers, where it's more consumer-orientated buying that happens even if we're in the middle of a pandemic. Or it means people who buy their milk, their bread, they're very consumer staple type businesses which exhibit very, that will make money and not go through these wild cyclical moves. Other examples might be transurban, which is toll roads, people travelling to and from work, people travelling around Melbourne or Sydney, paying their toll as they go around there. So they're defined as defensive stocks. You then have this group of stocks called cyclical stocks. Now, cyclical stocks are typically stocks that as the word implies, move through ranges. And cyclical stocks can be more boom-bust type mentality. And we can use BHP as a great example. Most mining stocks are very cyclical. So iron ore might go through an upswing as it is at the moment. It might get to $150 a tonne. And then on the back end of that, you see BHP's Fortescue share price rise. But if the business cycle then starts to tip over, steel making starts to stop, the building industry goes into a downward trend, the demand for iron ore starts to fall, then the price of iron ore starts to fall. And you go through these swings around the business cycle, which means BHP share price might fall from $48 back down to $28 as the cycle goes through. And you need to understand, therefore, how you make money out of a cyclical stock from a growth stock or a defensive or income stock. The last phrase that gets used a lot is called blue chip stocks. Now, I think it's funny, it's a name that gets thrown around a lot, which people don't really understand. And I think the term blue chip is more around just saying it's one of the better businesses on the share market. And what makes it a better business is really subjective. Typically, blue chip stocks are companies that have got very long-term management, they've got long-term businesses that have been around for a long time, they've got a great track record of producing profit, a great track record of producing dividends and providing a return to shareholders. That would be what we define as blue chip. Now, one of the things I'll probably pass a little bit of caution of is that just because it was blue chip in the past doesn't mean it's going to be blue chip in the future. So tread carefully when you're looking at those sort of things, and everyone has a different definition of what is blue chip. Let's talk a minute about the share market. So the share market is, and to give you an example, the ASX has approximately 2,500 shares listed on it of companies you can trade in on a day-to-day basis. And there are two ways of investing in the share market. There is what we call a primary market and there is what we call a secondary market. Now, the primary market is where you buy shares in what we call an IPO, initial public offering, where the company might have been unlisted and wants to list on the share market. They produce a prospectus, they go send that out to people, and for many, I don't know the audience I'm talking to, but for many will remember Telstra back in the 2000s. They listed on the Australian share market. They did an IPO, and people could subscribe to shares through the prospectus, and then they became shareholders of Telstra. Now, that's what we call the primary market. So primary market is when you go through the prospectus, you fill it out, you send off your check, and you get allocated some shares. Once the shares are listed on the very first day, so when Telstra shares listed on the first day, then you buy in shares no longer through that prospectus anymore. You don't fill out the application form, you don't send off your check, crossing your fingers hoping you'll get allocated some shares. You then buy your shares through the secondary market, which is the main share market mechanism, which is where you ring a stockbroker or you go to your online account, you put in an order. The order might be for 1,000 Telstra shares at a certain price or at market value, and then that transaction is conducted that day. In fact, that minute or that second. You become instantaneously the owner of that 1,000 shares. We then operate on what we call T+2 settlement terms, which is transaction plus 2 business days, which means 2 business days after that, you'll then have to pay for those shares to become the legal owner of them. But the secondary market is that market which occurs that you'll probably see a lot on the news and things like that, where people are buying and selling from one another. You're no longer buying it the company's no longer raising capital and issuing it via prospectus. So the secondary market should also be noted that a lot of people go, who's buying all these shares or who's selling all these shares, and if there's lots of turnover, does that mean there's more sellers than buyers or more buyers than sellers? No, because remember, for every buyer, there's got to be a seller. So, if there's 1 million shares that are traded that day, that means 1 million shares were bought by somebody and 1 million shares were sold by somebody. It might mean if there's more people trying to sell at the same time, and you can see that in various mechanisms, it could push the share price lower. And if more people are trying to buy, but ultimately it can push the share price higher. But ultimately, whatever gets traded, there's a seller and buyer, it's all equal. So one of the things you should all know is that the ASX has certain trading hours. So the ASX is open this is in Adelaide time, from 9:30 a.m. in the morning till 3:30 p.m. in the afternoon. And there are certain days where the ASX is closed, which might be public holidays and various days throughout the year. But literally probably 350 days a year, the share market is open between 9:30 and 3:30. You will see between the hours of between the time of 3:30 to 3:40, there's what we call a post-market trading mechanism where they give you 10 minutes extra to do a trade, but it's a washout trade, just to help people tidy up any leftover parcels that have been, that have been left throughout the day that haven't been sold. But the primary hours are between 9:30 and 3:30, and ultimately the market doesn't shut for lunch. We don't go out for smoko. We don't get toilet breaks or anything. It's just trading flat out between those hours. Of course, it doesn't trade on weekends. But ultimately, it's really important to know what the trading hours and trading times are, because if you put on an order and you ring your stockbroker at, say, 4 o'clock in the afternoon and you say, I want to buy 1,000 BHP shares, the market's shut. But a lot of people fall into the trap of going, okay, they saw the last price was $45. They assume then that the first price the next morning will still be $45. That is a fatal assumption. You put your order on that night, the night before, the market's then it doesn't reopen for another 12 hours or so. But in the middle of that time, the US share market is traded, the UK share market is traded, which are major influences on the Australian share market direction. Now, if you've put the order on and then the US market overnight has a downward trend of moves down 2%, what you can expect, the opening price of BHP the next morning is not going to be $45. It could potentially be, the first price could be $44. And if you were selling, not buying, that difference could be quite substantial. So if you miss the market in the afternoon and you want to be very, very careful that you understand what price it is you're going to pay the next day, because it isn't necessarily the closing price of that day. So how do you buy and sell shares? There's probably a couple of mechanisms that you can do this now. And my background is I worked as a stockbroker for 17 years. And as a stockbroker, we had clients that would ring us. They will say, yep, Tony, I want to buy 1,000 BHP shares. We will then go into their account, put the transaction on. Transaction would get executed. The client would get a contract note and be notified of the purchase, again with settlement a couple of days later. So that is what I call a traditional stockbroking mechanism. There are probably two types of stockbrokers out there at the moment. One is probably the more transactional, just execution-only stockbroking firms where you ring and they can't give you or don't give you any advice. They're just order takers, I'll call them. Which is fine. That's a no frills type service. You then have full service stockbroking firms where they probably will know more about your personal background. They know what types of stocks you like, what types of stocks you're trying to invest in. They might know whether you want income stocks or growth stocks. They might know. They'll probably provide more research and background around if you were asking about certain stocks. But for that service, of course, the no frills service isn't going to cost as much as the full service stockbroking service. So you need to be careful, what you're getting for what you're paying for sort of attitude. The other mechanism that's come up in the last 15 to 20 years is simply online broking accounts. So you can open a CommSec account or an E-Trade account and you just decide that you're going to do this yourself. So you'll log into your account, say you want to buy 1,000 BHP shares, you punch all the buttons and you buy those shares and sell those shares at your wish or your whim. Now, Obviously, there are some people that are confident enough to go and do that themselves. They don't necessarily want to use a stockbroker, and that is fine. Each to their own. The service, that online service, is also going to cost a lot less than a full broking service. A full broking services can cost probably, they might charge you every transaction up to around 1% of a share trade, whereas the online version probably charges around 0.1%. So it's a significant discount in terms of your trading costs. I will say with online broking accounts, some people they can be addictive, and they can cause people more trouble than they're worth, because it's so accessible. People do get a little bit obsessive compulsive with them, and they trade and trade and trade and trade. And I think ultimately they've just moved a lot of money around, paid some brokerage costs and made no money. So understand your behaviours, understand what type of personality you are, and use what you think is right for you. So one of the other questions we do get asked a lot about is investor protection. So a lot of times that we get asked about, well, can someone commit fraud? Can they take my shares? You know, a lot of questions like that, and particularly in this day and age where cyber hacking and cybersecurity is a massive issue. The ASX has a clearly, with chess and a lot of its rigour around cybersecurity, and is fantastic at protecting people's accounts and protecting people's monies. And they actually have a pool of money that can be used to protect investors about any fraudulent activity and the various things that can go wrong should it go wrong. But in my time in 28 years now of being involved with share markets, I have never seen this sort of activity go on, touch wood. But the one thing I will say probably on this point in cybersecurity and protection is make sure that where it can go wrong is make sure the shares, you understand the address where the paperwork is going, and you understand that the shares, whose name they're in. That is really crucial. Don't delegate it to some address that you're not aware of, or don't delegate into some name you're not aware of. So it's a custodian account or something like that. I know that our clients clearly know exactly it's in their names or in their super fund name, joint names, whatever it is, and they know where the paperwork is going. Just be careful and make sure you clearly understand those things. Why use the share market at all? Again, I use an acronym I've been talking about a lot lately called TINA, T-I-N-A. There is no alternative. At the moment, interest rates are quite poor. A lot of people are seeing interest rates on term deposits at 0.4%. Therefore, there's only two other alternatives. It's the share market or the property market. Now, of course, that involves additional risk and additional volatility. But ultimately, the share market is a mechanism that you can invest in different businesses and diversify your returns in a different way. Now, why should you invest? Is that there are certain categories of the world that do grow, and there are businesses that are changing daily. And the share market provides a mechanism that you can get exposure to these growth areas. And an example, I mentioned it before, was cybersecurity. So a lot of people go, you know what, I'm working on a day-to-day basis. I want to invest, or I think that cybersecurity is a great new area, or robotics or artificial intelligence. How do I get access to that? Because a lot of people aren't going to go out and open their own business in cybersecurity. They're not going to become a robotics expert or an AI expert. But that's the beauty about the share market. You can find a company that might do that already. You can buy shares in that, become a part owner of that company the next day, and therefore benefit, hopefully, if the company succeeds in the growth and rise of robotics or cybersecurity or artificial intelligence. So, you know, why you invest is try and benefit in areas that are outside of your expertise. Try and benefit in global growth in areas like health, in telecommunications or other areas that are growing, and it provides a way of doing that in a very liquid and transparent manner. So when you're investing and using the share market as a mechanism to do it, a lot of people define risk differently. And risk, what's risky to one person might not be risky to another. And what I mean by that is, you know, I look after a lot of farming clients, and I would argue that a farmer takes a lot of risk on a day-to-day basis, in the sense that they put in a crop, they wait for it to rain, and ultimately, if it doesn't rain, that obviously can decimate the income or the profit for that year. And yet I look at the share market and I look at a company like Woolworths and I say, well, you can buy shares in Woolworths, and I think that's a great low risk investment. The risk is my subjective opinion. So people who say the share market's too risky, that's from their viewpoint, and you need to probably be very cognizant that everyone attacks it from a different angle. So tread your own path with that. But risk, in a sense, is that you need to understand how you're going to make a return out of the share market. How do you want to make a return? So do you want to invest for income, which we talked about earlier? Do you want to invest for growth? Do you want a bit of a combination of the both? But the other thing that you need to understand about the share market is the risk is normally a timing risk. It's not an absolute risk. So one of the biggest things where I see a lot of clients, going back to September 11, GFC, most recently the COVID situation, is risk is where people are forced sellers of assets. One of the mantras that we have is you don't ever want to be a forced seller of an asset ever. So selling at bad times because you're forced to either pay for your mortgage or pay for a bill or pay for a tax bill or something is not okay. You want to be able to hold an asset, and using a Warren Buffett term is that he said when you go and invest in the share market, pretend that the share market closed the very next day and didn't reopen for 7 years. Would you want or panic about having the money back? And if the answer to that is no, because you've got plan B or plan C and you can deal with it, fantastic, go ahead and invest the money. But if the answer is, oh no, I would break out in a cold sweat and I would need the money back in the next 5 minutes, don't invest it in the first place. Timing here is crucial, but time in is crucial. So that can also then lead into the various stages of life or the things that you've got planned. And that's why we ask lots of questions up front about what your goals are. And obviously your stage of life, if you're a bit younger and you're in your 20s, you have a long time. You have a long time, and using the Warren Buffett rule, you might go, you know what? We have plenty of time here to ride this out, see the bumps and jumps, and ultimately come out through the other side of that. Whereas I've got a client maybe in their 80s and they don't have as much time to worry about it. And it doesn't have to be in their 80s. I've got clients that just couldn't bear the thought of not having their access to their money within that 7-year time frame or even a 5-year time frame. That really makes them feel uncomfortable. It doesn't pass the sleep test at all, and therefore I would argue you shouldn't invest in it. And that leads me into a very what I get asked a lot is people sell houses, and they sell the house and they go, well, Tony, we're in between houses. Well, we've got a $600,000 check from the sale of a house. Can you just help make us some money in the meantime while we're looking for the next house? Clearly, that doesn't pass this test. Those people, they're going to buy another house. It's just a question of when. And when they find the house they want access to their money. If I go and invest that money and we go through a COVID-style situation where the market drops 20%, they don't want to be a forced seller of that asset and take a 20% hit on their money. Make sure you've got your time frame set. It does depend on your stage of life, and it does depend on your access, how you want the access to your money and your liquidity situation. Think carefully about it. One of the things that really has been very important over the last 30 years of my career has been just constantly reviewing your investments. Share markets change, worlds change. We've seen in the most recent 5 or 10 years the rise of artificial intelligence, robotics. We've seen Afterpay, we've seen cloud computing, we've seen automation. We've seen a massive change in the way the world exists. And now, sustainables, renewables, as opposed to oil. So the companies of yesterday may not be the companies of tomorrow. And I use the phrase, what got you here may not get you there. And yes, there are some fantastic long-term companies, and I'm going to use the banks as a great example of that. They're fantastic. But just because they've made money in the past doesn't mean their business models can't be broken and they're not going to change. You need to constantly review the types of investments you have in line with the economics and business case of the day. We've all seen what happened to Kodak. We've all seen companies fall from grace. So blue chip companies can fall. Don't get complacent. Make sure you review your portfolio. Make sure you review where it's invested. Managing risk. So managing risk is probably my day-to-day job for a lot of clients, in that risk management is crucial, and how it applies in a share market sense, and we'll probably get into this more as we work our way through the course. But diversification, everyone hears about diversification over and over and over again, but diversification as it's so important. Don't have all your eggs in one basket. Spread it. Now, in a share market terms, what does that mean? So what it means is that there are, as I mentioned earlier, there's probably 2,000 to 2,500 shares listed on the ASX. I would argue that the ones that probably only matter in terms of size and scale are the top 300. So there's 2,200 companies on the ASX that are speculative in nature. They're fly-by-night, can be fly-by-night companies that you might not want to touch, but there might be 300 companies that are listed that you want to care about, of good quality. Now, within that 300, this is where the diversification starts, is that in that 300, you've got banks, you've got resources, you've got IT companies, you've got travel and leisure companies, you've got all sorts of different business models, or business sectors, I should say, that exist in that 300. So what you want to do is, when you're putting a portfolio together, you don't want to say, hey, yeah, Tony, I want to put $100,000. Oh, those 4 robotics and AI companies will look fantastic. Then you're technically, even though you're buying 4 different companies, they're all in the same sector. And so you want to try and avoid that. Now, I think there's approximately 14 what we call GICS sectors, GICS sectors in the share market. You want to try and, at least in a portfolio, represent between 10 and 12 or 14 of those sectors in your portfolio, so that when one sector is not performing, and most recently we've got a great example of that with COVID, if you'd had all your eggs in the travel basket and you'd owned Flight Centre and Webjet and Qantas in your share portfolio, you would have seen your portfolio get massacred during COVID. But if you'd diversified, and within that we've seen you own some health stocks, you own some technology stocks which have actually benefited from COVID, you would have then had some of the pain numbed by some stocks are going well, some stocks aren't. Overall, that's always going to happen. You're going to have some pluses and minuses. But the most important thing is, how is the bottom line going? So don't get too caught up in trying to just chase all the winners and have your money all sailing in the same direction. Diversification is still crucial, because just keeping the money you've worked hard for is still part of the game. Just diversification as well, I want to just take it one step further, is that you can also diversify across countries. So Australia is a very small dot in the ocean. So maybe you should look for companies or ways of diversifying internationally, because America has a much larger tech base than we have, has a much larger pharmaceutical base than we have. So don't just think, oh, well, I should just invest all in Australia either. Diversification also is about investing internationally as well. So when I'm talking about the share market, I think it's also important that we put it into context, and you'll hear a term called asset allocation. And a lot of clients laugh because they go, it's these pretty pie charts that the financial planning community put together and where your money's invested. And the reality of the situation is there is only probably, I'll call it 5 major areas that you can put your money. And the first one is just cash. And cash is just simply a cash in a bank that's available on 24 hours. The second major area is fixed interest or bonds, and you can put your money in fixed interest or government bonds. Now, as we know, both of those areas at the moment, these are defined in an asset allocation point of view as what we call defensive sectors. So everything above that line is defensive in a sense that you're not going to get any capital growth out of those types of investments. You're only going to get an income stream out of them. And they're defensive because you put your money in, you want your money back. And that's the whole reason we use this. Below the line here, there's property. And when we talk about property, you can split that into 2 categories, residential and commercial. There's Australian shares, or equities as we call it, and then there's international shares or equities. Now, everything below this line is defined as growth, because you get out of property, Australian shares and international shares, you'll get income through dividends, and we've already talked about that can vary a lot, but you will see capital growth. If the profits grow and you see the business improving, their share prices will go up or the property prices will go up, and that way you get some capital growth and return on your investment that way. So overall, there are 2 major categories called defensive and growth. Here's how it's broken down across all these different asset allocations. And that's really important to understand what are your alternatives and what should a balanced portfolio look like. So with this framework in mind, there is you'll get a different, it get termed in terms of risk profile, and clients will have different categories. So if a client is deemed a cautious or conservative investor, they will allocate probably 60 or 70% of their money to these what we call defensive characteristics, cash and fixed interest. Now, remembering though, if you're defined as that 60 or 70% of your money there currently as it stands today is in that category, you're probably earning between 0 and 1% on your money. So being very clear about what risk profile am I? I'm cautious. 60 or 70% of my money is in defensive. Therefore, 60 or 70% of my money is earning 1% is crucial understanding that you know where your money is. Similarly, though, if you get defined as an aggressive investor, and I know that sounds like a poor term, or a high growth investor, 60 or 70% of your money, or probably even up to 80 or 90% of your money, might be in everything below the line here. So we'll be invested in property and the share markets, both internationally and Australia. Now, if you have a growth focus and you're investing in these sort of categories, you can expect a lot more volatility in terms of when you look up your balance all the time. As markets move up and down, everything here will show a lot more price movement than everything up on the defensive category. Know what your profile is, know where your money is, and know how it's diversified. So I want to talk about the risks and I guess risks of share market investing. And I've alluded to one earlier in this talk, is the risk of capital loss. Now, capital loss really only occurs when you've bought something at a price and you sell it at a lower price. Again, both of those decisions are within your power. Sometimes a business fails and collapses altogether, which is not in your power, but the risk of capital loss over a whole portfolio is something that you should think about and talk about. As I said, I applied the Warren Buffett 7-year rule earlier. Be very conscious of your timing and be very conscious of what you're willing to tolerate if a share price falls. When do you need to review the stock? When should you talk about it with your advisor? Trying to minimise capital loss at all times is still pretty crucial. Talking about minimising capital loss is then we talk about volatility. And as I said earlier, volatility doesn't equal risk. Just because share prices move around and gyrate on a day-to-day basis. And I could give you a really good example probably over the last 12 months is that we've seen Woolworths share price go from $38 a share, it went all the way down to $23 a share and is now currently up at $40 a share. That is nearly a 50% swing in the share price. That's, in anyone's language, that would make a lot of people squirm and feel uncomfortable. Volatility, though, doesn't equal risk. Is Woolworths still a good, sound, secure operating business? Yes, it is. Just because share prices move around is not necessarily a reflection of the underlying business. So you need to separate the two apart and say volatility is over here and the risk of the company is over here. Don't assume that they are the same. We talk a bit about timing risk, and timing risk is just simply about, probably understanding where the chart is, where the share price is in relation to time. Timing's hard, and I think you have to be very careful about that and trying to time stocks. But timing risk, more the approach we have with that is just buy good quality stocks at good times. Don't try and be perfect. Don't try and pick it at the bottom because you'll never do it. Don't try and sell out always at the top. You'll never pick it. Just make sure you just buy and sell on your terms. There are other risks. There's currency risk. So if the Aussie dollar goes up and down, make sure you know how that affects your company. There's legislative risk. So for example, if a business like Crown Casino at the moment runs in, if they say they haven't been operating the casino in line with current legislation, they could take their licenses away. So there's all sorts of other risks. They're real just typical business risks that exist in anyone's business. So thanks for listening today. This has obviously been a quick intro into parts of the share market. We're going to keep building on this knowledge and keep growing your understanding of that. I'm more than happy if you've got questions out of tonight's session, email myself and reach out and we'll get back to you as soon as we can. Thanks for joining us today.